everyone. Welcome to the KE Report and a daily editorial on Friday, May 23rd, chatting with Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. Marc, we have tariffs to talk about. It seemed like tariffs were maybe a little bit behind us. We had a nice pause in all the tariff talk, but Trump now announcing potentially a 50% tariff on goods coming from the European Union, stating that talks are going nowhere and this tariff could be coming in a matter of weeks. And of course, this is moving markets. European markets are down. US markets open down, but they're fighting back. They're still down for the day, but they're getting close to parity. Who knows where they're going to close? US dollar, that's getting hit. Precious metals, those are benefiting from this as they seem to do in this political turmoil environment that we continue to see. So, Marc, in terms of the news out today, we always talk to you about currencies, but really opening up the table to you here, what is this tariff announcement or potential tariff announcement doing in terms of changing some of the short-term trends we've been experiencing?
Well, yeah, thanks, Corey. I think that, the trend had already changed before we came into today when President Trump put on the social media that he was going to recommend, and I'm not sure he's going to recommend it too, besides himself, recommend that the EU gets hit with a 50% tariff, which, of course, given the current state of play, is harsher than what's going on with China. The euro was already bid on the day. In fact, we were testing a Fibonacci retracement objective near 113.80. Euro set back to almost 113, but it caught a good bid and we're back closer to highs now. But the European asset markets responded dramatically, like you would expect. Stock market got hit. The Dow Jones stock 600 fell, but it was a third day in a row it fell. So it was kind of soft coming in today, but it fell almost by 1%, which is really the most since in a little bit more than a month that the European stocks fell. And the bond market rallied as well. And I think here the logic, it might escape many people, but I think the logic is that if the US is going to put a 50% tariff on EU goods, that this is going to be a big economic shock to Europe. And what you'd want to, so how big of a shock? Well, it could put Europe, which just the growth has been fragile, especially since the Russian invasion of Ukraine. Many people would be afraid then that this kind of shock from U.S. tariffs, let alone the counter tariff that Europe is probably going to announce, is going to maybe push Europe back into recession. And what this means then is not so good for corporate Europe. Equity market gets hit, but what one does then is buy bonds on recession fears, and European bond yields are down 6 to 8 basis points today. Put that in perspective, the U.S. 10-year is only down about 2 basis points. So we've got a big rally in European bonds, big sell-off in European stocks, and the euro is up on the day. And in fact, in a bigger picture, thinking about the dollar index, which the euro is the biggest component of, the dollar index has been correcting higher in recent weeks. In fact, this week, the dollar index looks like it's going to break a 4-week uptrend. And as we, so that uptrend now, clearly in hindsight, looks very corrective in nature rather than an impulsive move. And just today, ahead of the weekend, on Friday, when we're recording this, the British pound has made new multi-year highs. The Canadian dollar has made new highs for the year. And the Chinese currency has also made new highs for the year. The dollar is broadly weaker, and we're seeing some extreme moves. There's some very dramatic moves here.
Well, Marc, I'm glad you went into that with the other currencies hitting highs like the pound sterling and the Canadian dollar. I mean, that's probably a lot of the weakness we're seeing in the US dollar index is the other currencies appreciating so much, but I know that it's a dual-pronged approach. Part of it is how other currencies react to the dollar, like the euro, like the pound, like the yen, but the other part of it is the fiscal health of the US. So how much of this dollar move down is US related and how much of it is currency related?
Yeah, that's a good question, Chad. I think that for the most part, I'd say it's primarily a dollar move. So sometimes in the currencies, like I say, dollar yen, I often found the dollar yen very sensitive to U.S. interest rates. That's not the case now. The same thing with the euro. I often find that the euro sort of tracks more or less the change in the U.S. premium, 2-year premium over Germany. So I think the dollar has been decoupled from the interest. So when the interest rates, and so when I look at the correlations, for example, the dollar yen is not so much correlated to the U.S. 10-year yield as it is to the dollar index itself. Same thing with the Canadian dollar. I often find the Canadian dollar is a risk-off currency. So when the stocks in the U.S. get hit, the Canadian dollar tends to weaken. That also has become decoupled, where the Canadian dollar now has a much higher correlation with the dollar index than it does with the S&P. But in sterling's case, the UK's had some interesting news this week. Higher than expected inflation, stronger than expected retail sales. And the consequence is the market has pushed out in time the next Bank of England rate cut. And so favorable economic news, interest rate adjustment, I think helps explain sterling's strong performance. To say strong performance because of the level it reached. But in terms of within the G10 currencies, sterling is sort of middle of the pack, up about 1.6% this week.
So, with some of these changes in historical trends or correlations in the currency markets, this is all very reminiscent of this whole theme of sell America, whether it's stocks, whether it's bonds, whether it's currencies. Mark, is this still a theme in your eyes in terms of just looking at the currency markets and some of the changes you're seeing that could be longer lasting and really upset the historical norms we're used to?
Well, I do think there's something to this about selling America. So I'm hesitant about it for a couple of reasons. One is that I think the markets often attribute structural forces to what ultimately are cyclical. Here's what we know. Americans, foreign investors, heavily overweight U.S. assets because they had outperformed for so long. And so we come into this year and there's pressure to adjust portfolios, changing what's happening in Washington, all spurring on or incentivizing people to adjust their portfolios. But I would say that when you look at like the most authoritative source of flow data that we have is really from the U.S. And it's really the tick data, which comes out in the middle of the month. So all we have so far really is March's data. We don't have April data quite yet, just given the lag. And so far in Q1 of 2025, there was a net purchase of about $350 billion worth of U.S. stocks and bonds in Q1. In the first quarter of 2024, there was only $40 billion net investment coming into the U.S. So I do see signs, what people tend to focus on, it flows into the ETFs, foreign ETFs and whatnot. But I think that it seems to me, just looking at prices, lower bond prices mean more sellers than buyers. Same thing with stocks. So it does seem to me reasonable that somebody is selling stocks and bonds. And given the weaker dollar, it's easy to see that connection why it could be foreign investors. So I suspect that when the dust is settled, it'll be shown that Americans ourselves have been the big sellers of U.S. assets. I have this week came across a quote from the Swiss National Bank president, and he essentially said that, let me see if I have this quote right here. He says, U.S. treasuries remain extremely liquid. There's currently no alternative to them, and none is foreseeable. And that was from the Swiss National Bank president, of course, who has U.S. equities and U.S. bonds in their reserves. I think a similar note came from the largest Canadian pension fund. As of Q1, it said it had 47% of its portfolio in the U.S. 47% end of March. That's up from 42% in 2024 and 36% in 2023. So I'm just reluctant to think that these large pools of capital, when we think about these large pools of capital, it's not just the hedge funds and the hot money that moves around and tries to capture sometimes small incremental returns. That's one set of pool of capital. But the other pool of capital are the sovereign wealth funds, pension funds, central bank reserves. And I'm not convinced that those types of actors move at anything more than a glacial speed. So while there might be some adjustment to portfolios, reweighting, readjusting, cut some of your winners back, add up to some of the weaker performers. But I'm really not sure that what we've seen yet is a capital strike against the U.S. I do see pressure on the dollar. And when I look at the time zones, the pressure on the dollar does seem to be coming more overnight. That is to say, in Asia and a little bit in Europe, more so than the US itself. So it is interesting, but I say that we shouldn't jump to conclusions, and we should be aware of our like penchant on Wall Street to attribute structural long-term forces that ultimately prove to be cyclical and tactical.
Yeah, you raise some interesting points, Mark. I think there's probably a lot of U.S. investors that have been doing some of the selling of U.S. assets, and sounds like a lot of Canadians still have their retirement and pension tied up in U.S. assets as well as the Swiss bank. So I don't think there's, like you say, those large pools of capital aren't going to make really fast changes and suddenly sell America. And there's also a lot of Scandinavian countries that have really high weightings to even the tech sector even today. But you bring up an interesting point about part of this could be the sell America could be shorting the dollar to buy other assets. And we were talking off mic about how the yen has always traditionally been seen as the carry trade. And it could be that the US dollar is becoming the new global carry trade. So maybe unpack that idea for listeners.
Yeah, so when you think about it, as retail investors, we typically want to buy an asset, and we want that asset to go up. But these large pools of capital tend to think of it, I think, a little bit differently. And first, they don't play with their money. It's OPM, that is other people's money. So what a typical trade might be is you borrow the Japanese yen, and by borrowing it is another way to say you're short the yen. And with those proceeds from selling the yen, you buy some other asset, US Treasuries, stocks, Mexican pesos. And that so the trade is not just that the asset goes up, but that other asset that you've sold can go down. You make money both ways. And in a purely carry trade, you don't want the currency to move very much. You want to just pick up the yield. So you're short the yen, and you're basically getting it for, say, you're short the yen and you're paying about 1% or so to borrow it. And you're lending it to the US Treasury and you're picking up, say, 3.5%. In that kind of carry trade, you short the dollar, you short the yen rather, long treasuries. You don't want the currency to do anything. You'd be happy with the currency being flat and just picking up the yield differential. But I think that what's happened now is because of the very bearish view of the dollar and the belief that President Trump wants a weaker dollar, that you'd use the dollar as a funding leg of the currency. It might cost you more to borrow than the Japanese yen. But in this case, you get the depreciation of the dollar as a kicker to your overall return. So some people, like myself, short the dollar, long Mexican, in particular Pemex bonds. Pemex is a below investment grade oil company of Mexico, pays a very juicy yield of over 8.5%. So rather than use the Japanese yen, shorting that to fund the purchase of a Pemex bond, for example, some people like myself, in effect, have sold the dollar and bought the Pemex bond, using the dollar in effect as a funding currency.
Mark, what does this mean then for ongoing trading, either in currencies or even in the bond market?
So yeah, we've had this bounce in the dollar. I thought that there might be a little bit another push higher, like the dollar index peaked just shy of 102, and I thought there might have been a little bit more juice left out of it. It turns out that wasn't the case. So I think that the dollar's downtrend has resumed. And so one thing I think that it means is that not just that the dollar is going to fall, but it means other currencies are going to rise. And so it might not be too late for US dollar-based investors to still diversify their assets and buying foreign assets where you get the weaker dollar, stronger foreign currency as partly a sort of the extra frosting on the cake. But I also think that it means that we're not out of trouble yet. I mean, that you think about where the trouble can be, and you just put your head, like try to get your head around what policymakers would be concerned about. And we do have stress, and the stress isn't just in the US bond market. The stress is also in the Japanese bond market, where the yields have really jumped much further, especially at the long end. At the long end in Japan, we're talking about, say, the 30-year and the 40-year. Several weeks in a row now, those bonds have been selling off. The U.S. 10-year yield has only been rising, I say only, but for the past 4 weeks. And so we've got the two biggest bond markets in the world are under some pressure. And this could lead to spillover dislocations in the capital markets because both of these bond markets are very central to world investors. So I still think that we're still not out of this. Like I'd say that if this was some kind of stress meter, I'd say that we're out of 1 to 10, we're probably around a 6 or a 7. We're not at a crisis yet, but we could see how the crisis could emanate from a rapid rise in U.S., Japanese interest rates, volatility in the currencies. And we got to remember that there's a lot of large pools of capital that are playing for small little incremental spreads, whether it's like parts of the curve, overnight money against 2-year money, all kinds of different ways that they're sliced and diced. And I think that there's, sort of like as Warren Buffett said, when the tide goes out, you see who's wearing a swimming suit. And I think that that's true now, that stresses seem to be building up in the system. And we just want to be particularly sensitive to those because they can bubble over at any moment.
Yeah, there is some potential things that could be a powder keg if they happened, but I guess this brings into focus if the US rates were to go up, does that force the Fed's hand to start cutting rates? It seemed like, Mark, if we think back like just a year or two, the entire episode was about what was the Fed going to do and reading the tea leaves of economic data to figure out what they could do. Coming in this year, people were expecting 4 or 5 cuts. Now we're down to like 1 or 2 cuts. So does this force the Fed's hand if the rates go up to start cutting rates?
Well, I think it's not so much if rates go up, will they start cutting rates. It's not simply about rates. I'd say overall financial conditions, if they tighten, and tightening would be, as we've seen, right? Rising interest rates, falling stocks, financial conditions are tightening. But it reached that point where it's too much. And I'd say that the comments, and we've seen, I want to say 11 or 12 Fed officials speak in the past few days. Nobody seems to be in a hurry to cut interest rates. If anything, we've seen from the New York Fed President Williams and Atlanta Fed President Bostic more ideas that the Fed needs to be patient for longer. And the market has pushed out the next Fed cut. Right now, it's not fully priced in until really you get into October. So it's not even in September any longer. September is a little bit better, say that close to 60% chance. It's not fully priced until October. And then you're looking at just a calendar effect of how many times you can cut. The market right now, to your point, Shad, does not even have 50 basis points of cuts fully discounted for this year.
Yeah, I think everybody's on hold. And again, today, Friday, was a great example of just how quickly things can change in the market. Everyone thought the tariffs were kind of on the back seat or the back door on their way out, but now all of a sudden they're back on the table. And Trump can, it seems like, move markets very, very quickly. And that's keeping the Fed, keeping, I think, a lot of investors and even companies a bit more handcuffed in terms of what they're going to do with their money and their policies. I guess it seems kind of silly, but what's coming, Mark? Anything on the horizon outside of, again, what we cannot predict coming out of the Oval Office next week or the next couple of weeks that could be market relevant?
Well, I think, as President Trump hinted today, if those tariffs go into effect on Europe, it puts Europe at a very difficult position. And I'll share an idea that I've been playing with, and that is if the U.S. cannot be, if the U.S. and Europe sort of are fracturing that relationship, we don't trust each other as much. The tariffs are going to be punishing Europe economically. President Trump says that the EU was only created to hurt the United States. This kind of tension, I think it's going to force different behavior from Europe that could in turn affect the grand strategy. Here's what I'm thinking about. Europe has to recognize it's just a regional power. It doesn't have the resources to really project its power around the world the way the U.S. does, or maybe even the way China does. So I can imagine a scenario in which the EU cuts a deal with China. They can't fight with sort of what some people call the dragon bear Russia-China alliance on their east, and having this fractured relationship with the U.S. in the west, the Atlantic. And so I could see where China and the EU find an agreement. And if the EU and China can find an agreement, I can imagine what that would be like. What's Europe's interest is in protecting its eastern flank. And so maybe I think, what's the price to pay so China gets Russia to back off? And part of it might be that the EU has to give China a trade agreement. Allow Chinese companies, if they don't want Chinese exports, allow Chinese companies to build into territory within the EU. and not just Hungary. And in exchange, the EU needs to recognize that it cannot project its power into the Southeast China Sea. And in effect, what I'm saying, it sounds kind of bald to say this right now, but maybe it's what Europe needs to do, given the U.S. attitude, is protect Poland, and that might call it to sacrifice Taiwan. So the quid pro quo, if you will, is Europe asks China, get Russia off our back, and to China, make your trade practices less onerous. We'll let you invest foreign direct investment within the EU, creating jobs, technology transfers for us. And in exchange, Europe recognizes that it cannot project its power into Southeast Asia and doesn't have a dog in the fight between China and Taiwan.
Tough position that Europe's in. Hey, it wasn't long ago that it was Canada and Mexico that were facing a lot of tariff news, and now it's Europe's turn. Who's next? Boy, oh boy, I'm sure there's going to be another country on Trump's radar, but right now, to end this week, it's Europe's turn. Boy, oh boy, what a crazy market we live in a wild world right now. Marc, great chatting with you again. Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark II Market website. Click the link in the show notes to visit Marc's website. Marc, thanks again for your time. I hope you have a great weekend.
Thanks. Good luck to everybody.